I can get the color pen I want as always. All right, so this was an error on my part. I do apologize. This is actually from Mark K. Mark S. had the second question that came in. But Mark K's question is regarding a short strangle position. And he wants to go over defending the short strangle position that might move against you. And he wanted to know if you ever heard of an inverted strangle to defend an open strangle position. Now, disclaimer, I personally do not trade short strangles in my account. I don't believe I ever have. I'm going to talk about the defense, but in a theoretical manner, looking at an example, and we'll look at a live example also in that scenario. All right, but to begin, let's talk about what is a short strangle. A short strangle is typically done by selling an out-of-the-money call above the current stock price and at the same time selling an out-of-the-money put below the stock price. So we're out-of-the-money call and out-of-the-money put. Now this is similar to an iron condor structure, but it's without the other wings. I'm not buying an extra further out of the money call and further out of the money put. I essentially just have a naked call and a naked put, both out of the money. It is still a neutral strategy. I need the stock to remain between the strike prices at expiration so that both options expire worthless and we keep the net credit from the two short transactions. So going back, September 29th, 2017, ATVI, it had earnings today, but this is a stock I'm in my portfolio with a radioactive trade, so I just grabbed this one because I know the movements. Well, ATVI is trading at 64.51 on September 29th. I could enter a short strangle by selling the out-of-the-money 20th of October 66 call for 80 cents. I'd also sell to open a 20 October 62.5 put, 2 points below the stock price at 65 cents. We generate a net premium of $1.45. Now, there is a margin requirement. It varies from broker to broker. Some are different depending on how you enter it. But in general, I think it's some variation of a percentage of the short put strike price or the short put strike price as a naked put where you may end up buying shares of stock times some margin combination or some ratio of the premium of the call that you received to get the full margin for the position. But each one's a little bit different. Okay, so you won't have to necessarily cover both as a naked call and a naked put. It's a naked put plus a little bit extra in most places, and then you can, if you have a margin portfolio, you can lower that too. But essentially, we do have a naked put and a naked call open is what it comes down to. All right? Okay, so only one side can lose. Now, ignore the stock price for right now. When the stock was, at 64.51, more of lines up here, we would have sold the 62.5 put and bought the 66 call, or sold the 66 call, I'm sorry. There's our short strangle. We take an infinite risk to the upside if the stock really gaps up and goes to infinity. I have not met the stock that goes to infinity yet. If you find it, please let me know. And of course, we have a loss of about 62.50, really 61.05 if the stock went to zero, because we'd have to be forced to buy shares of stock at 62.50. Now, neutral position, everything stays in the middle, both options expire worthless, you keep the 145 net credit, and you're free and clear. That's not always what happens with any plan and with any strategy. From September 29th moving forward, here's our stock chart of ATVI. After a little movement down and flirting with the 62.5 strike, which is marked here by this green line going across roughly, the stock on October 9th broke below 62.50 and was closed at around 61.18. So now we need to manage it. Our 62.5 put is in the money. We don't want to necessarily risk getting assigned the stock at 62.50, so we've got to come up with a management technique. Now, the inverted strangle. I had to look this up. I've never seen it before. I looked it up on the article they had on the Dough education site, DOUGH, which is from Tasty Trade and Tastyworks. I think this is where Mark K got this idea from. Their suggestion in an inverted strangle, if the stock moves against you on one side or the other, is to leave the threatened side alone. I'm not going to touch the put that's now in the money. They suggest rolling down the non-threatened side, the call, for a credit. And the hope is that the credit that you receive will hinder the loss that you might take, and if the stock continues down, you continue to roll down the call. You don't adjust the put. You leave that in the money, continue to roll down the call. So eventually, you end up with a strangle where the call is below the put strike price, sort of an in-the-money short strangle position. Okay? Very interesting. So on October 9th, we could have closed our October 66 call for 5 cents. We took in 80 cents initially into our net credit. And then I could have sold to open the 62.50, same strike as the put we had. This one is still out of the money with the stock at 61.18, and we would have received 55 cents. So I'm actually getting a credit for rolling down this call to a lower strike price of 50 cents. Now it's important to note that the cost, if I had bought back the 62.50 put I had sold that's now in the money on October 9th, would have been 182. Okay. Here is the new position. Remember, we took in $1.45 initial net credit for my 62.50 and 66 short strangle. That was our original net credit. The idea of going into an inverted strangle, which I haven't done yet, I've sort of created an inverted straddle here, but really just a straddle. It's a better term. But by rolling the call down the non-threatened side, we got an additional 55 cents of net credit. So now I'm at $1.90 net credit for this position on ATVI. Remember, the stock was trading at around 61.18. My lower break-even is now $60.60. The upper break-even is now $64.40. So you roll down the option that is not threatened, and you leave the other option that is still in the money. If at this time ATVI continued down in price and went to $60 per share, their advice would be to buy to close the 62.50 call and move that down to the 60 strike. So maybe you get another 85 cents of net credit, maybe another 65 cents, 85 cents. So now your net credit is going up to $2.75 with an in-the-money strangle, 60 call, 62.5 put, which is $2.50 in the money. So it's still 25-cent profit, even if you have to pay the full $2.50 back at expiration, which they always do. They always would try to close it at expiration. So this is what's called the inverted strangle. Now, what ended up happening in our example, we rolled the call down here to 62.5. And I don't know the exact date because I cut off the dates here, but it was either here or here. On 20th of October, ATVI was at 62.64 or something along those lines. So where does that leave me? Well, now that 62.5 put still expires, and I have to pay 14 cents to buy to close the 62.50 call to avoid assignment. Okay. Now, if I was further out in time, if it wasn't October 20th expiration, somewhere in this time frame, if I was trading the November 3rd or the November 10th and rolled down to the 62.5 call, when it moved above 62.5, or probably here when it moved to 64, they would suggest leaving the 62.5 call alone and now moving the put up, buying to close the 62.5 put, which is cheaper, might be only 5 or 10 cents with the stock at 64 or 63, 5 days to expiration, and maybe selling the 64 or the 65 put. Okay, and if the stock continues up, you'd roll that put again, but you're leaving the 62.5 call in the money. my real concern with this inverted strangle concept, let me go back 2 slides. Let me go back to the original position, okay? Is their idea is to move the out-of-the-money call to lower strike prices and leave the naked put in the money. Well, remember what can happen when an option is in the money. You can be assigned at any time. Okay, so you'd be forced to buy shares of stock. Now that's okay. In a sense, you'd be converted to a covered call. It might still give you a profit depending on how far you rolled this down to. The assumption with this inverted strangle to repair a short strangle is that you wouldn't be assigned early. You could still close out the short put or the short call before expiration. Okay. On the reverse side, if the stock moved up to $69 per share and I rolled my put from $62.50, this is my put now, up to say 68, so now I've got a strangle with a 66 call and a 68 put. The stock may be trading, let's say, at $67.50. Why they mean inverted is because the put's at a higher strike than the call. It's kind of an in-the-money strangle at this point. And what ends up happening now is that if I get assigned on the short call early, for whatever reason, 5 days, 6 days before expiration, before I close it trying to manage this, if I get assigned on the short call, I'm now short stock with a naked put open, which becomes a covered put, sort of the opposite of a covered call. The reason I'm concerned about this adjustment is if they're experienced trading it, as I mentioned, all mine is theoretical, but if they're experienced trading it, is you tend not to get assigned early in most situations, or if there's an ex-dividend date, you make sure to close the option. Well, you're ending up with an in-the-money option that may be assigned early, and it would change the whole dynamic of the trade. I don't know any further about that. That's one of the risks and the concerns I have about managing the short strangle to this inverted strangle idea, because you could be assigned at any time. You haven't canceled the obligation of an in-the-money short option, whether on the call side if the stock moved up or on the put side if the stock moved down. What else could be done in a short strangle? Well, remember, I could have closed the put when it breached that lower strike price at 182, taken the loss. The original credit was 145, so I'd have a loss of 37 cents and move on to a new trade. I could have bought to close the put at 182, knowing that my loss was 37 cents. Remember, the stock was at 61.18, and maybe just rolled down to the 60 strike put for October 20th and maybe gotten another 30 or 40 cents, putting me at no profit or loss, but at no loss. If the stock recovered as it did and ended up between the strike prices, my 60 now put and my 66 call would have expired worthless. You could do nothing and hope the stock recovers. In this case, it did. If we did nothing after it breached 61.18, by October 20th, ATVI had moved back between the two strike prices. We would have gotten that max $1.45 net credit. You could move the entire spread. Remember our original position, let me draw it up here briefly. The original position was the 66 call and the 62.5 put. So when the stock dropped down to 61.18, closing the whole position would have been a loss of about 37 cents. What if now I rolled my 20th October series, bought back both options, loss of 37 cents, but maybe sold a November 3rd, rolling it out in time, 61 and 65 strangle. Okay? Well, as we saw with the stock chart, it did briefly go above 65, but then it came right back down and is trading at 63. So this would have expired with us. This probably would have been the 60-65 strangle in this case. And so then it would have expired. But rolling it out in time, I might have gotten another 50 or 60 cents here. So my max profit's only 20 cents between the strikes. Not a high return, but not a loss. Okay, so we adjusted everything down based on your criteria, looking for the probability between you'd want on the short strangle, going to the new position, and so forth. Someone mentioned to me once about taking the initial strangle that you have, the initial short strangle, again here, and buying a further out strangle to create a double diagonal. So here's my 20th of October positions, the 66 and the 62.50. And now what I might have done is bought December, let's see here, I don't know, 68 call and maybe 61 put. So now I've entered into a double diagonal position. That's not really great. There we go. Like a Batman kind of view here. But entered into a double diagonal where I'd managed the two shorts at October 20th, but I'm still holding the December call and the December put. So then I'd sell new premiums in between for November 3rd, maybe November 20th, keep rolling it as a weekly position, as a weekly double diagonal to try to get back to break even. But if it gaps up really high or gaps down really low, I now have the outside wings out to December to help hedge the potential loss in the position, not having a naked call or naked put open, or continuing to roll the position to an existing straddle or strangle with still a naked call and a naked put without any floor on the bottom. Okay, so that's another idea. Inverted strangle we talked about based on what I read at 4:05 after I had a chance to sit down and start working the slides today. By the way, that's why you're not seeing a lot of graphical interpretations for all these ideas, because I just started working on this at 4:05 before our 4:30 presentation. And of course the other idea is, as the stock moves down, in our case for ATVI, and went down to 61, I could have paid $1.82 to close that put, rolled the short call down as we did, but if I'm still expecting now the stock is bearish and the trend has changed and it's going to drop, I could have bought a put option that would continue to profit if the stock moved down. Essentially, a synthetic short position, short stock. You're short a call and long a put, you end up in a synthetic short stock position. Carries a lot of risk, but if you're right and it continues to move down, there's your profit. Reverse, buy to close the short call, buy a higher strike call. If it keeps going up, you're now in a synthetic long stock position. And you could protect that with a married put, and you could protect the synthetic short by buying an additional call to have a married call position. I just drew that wrong. I'm sorry. The married call position would be here. So synthetic short stock with an extra long call to cover risk. That's another idea. Okay? All right, so that's my ideas on short strangles. We took a look at this inverted strangle idea. You're not moving the option that's threatened. You're moving the option that's cheaper to buy back to a different strike price to roll for a credit, and eventually you may keep rolling it to where on your strangle, your short call's below the short put strike price, essentially what I'd call an in-the-money strangle. Or if you're rolling the put up as the stock's moving up to get a higher credit, eventually the short put will be above the short call. You'll be in an in-the-money strangle as well. The idea being that hopefully the premium that you're getting counters the loss, as we saw. The inverted strangle, I showed it as an inverted straddle, rolling the call down to the same put strike price, the 62.5. Would have worked in this scenario because the stock only moved back up to 62.65 or so. The call was now in the money. We just would have bought to close the call for 15 cents, and we increased our credit up to $1.90. So I think it was a good play in this situation. The risk is being in a strangle on a stock that's moving up and down, where, as you saw, we roll the call down as the stock's falling, then it reverses, and we have to roll the put up. Eventually, that short call is just getting deeper and deeper in the money. And you're going to have to close it before expiration, but there's still that threat of getting assigned early on either option if it's in the money, and that changes the whole dynamic. Remember, you're trading a strangle or a spread and using margin because you didn't want to buy the stock and do a covered call, right? You wanted to do a short strangle because you thought the stock was going to be between and not pay the cost. So you don't want to get assigned on an in-the-money put because you don't want to have to pay out the money to buy the stock. And on the reverse side, you probably didn't want a short stock exactly, or you would have just done a bearish play. So those are things to consider with my understanding of what I read about using that inverted strangle to repair a position. You end up at some time or another with an in-the-money call or an in-the-money put, and that carries the risk. All right, now, Second question that came in from Mark S., and this is going to be a quick one. We're just going to use the PowerOptions tools to illustrate this, and then we're going to get to our other questions that came in. Now, Mark S.'s situation is he's owned shares of Sprint at $7.97. Currently a loss of 131. It was a long stock position. Now, if he wants to hedge using put options, would selling the January 17th, 2027 put for 123 and purchasing a January 19th, 218 for 8 for 147 be a viable strategy? I'm going to say no off the bat, but let's take a look, okay? So what I'm going to do now is pause the screen. We're going to navigate on over to PowerOptions. Here we go. All right, so let me just make sure this is shown here, folks. There we go. Okay, so now we're looking at the PowerOptions tools. I've created a portfolio for us today, which shows a different ATVI Strangle for the 10th of November expiration, since we're already past October 20th. But here's our Sprint position. 100 shares of stock at $7.97, currently a loss of 130 with the stock trading at $6.67. Now, as I'm tracking any stock, any position, any options play in the PowerOptions portfolio, the first thing I want to do is see my adjustments that are available potentially. So I'll go to the Position Actions view and Position Analysis. The Position Analysis tool is going to give you a breakdown of your current position. Here's just our long stock, I know. Shows us our current loss liquidation value, about 16.3% after 9 days. And then it does show us some rollout opportunities. And when you're tracking a long stock on PowerOptions, what it'll typically show you is ways to maybe reduce some of the loss by selling an at or out of the money call, creating a covered call position, not getting a lot of premium because the stock's at 667. We'd have to go out to December series, the weeklies, but we're getting 16 cents, 20 cents, 26 cents, and so forth, okay? So we're not repairing right away. But if my anticipation is that Sprint is not going to go above $7 in the next 42, 30, or maybe even 21 days, I might consider selling that 7-strike call for 17 cents. Doesn't give me a lot of premium, does it? But at the same time, if I get 17 cents of premium, and I'm able to sell the just out of the money 30 or 32 day out, just out of the money option and get 17 cents, we know that it's going to take us about 10 months, maybe 9 months, we'll call it 9 to 10 months, to generate the 130 that we're currently down. Okay, this is a benchmark. I'm not saying this is what you should do, but this is a benchmark. So the just OTM call, 7-strike right now, 10 months, if I'm able to get 17 cents to pay for this 130. I'm going to have to pay some commissions. I might have to buy back a call if it goes up to 702 or 703 at some point. Or if it drops further, I might only get 15 cents instead of 17. We know it's going to be changing. But this is just a benchmark. Simple management, 10 months, maybe 300 days of this position. Now, the question, the evaluation that comes in, what we want to look at here is we're going to want to repair this with puts, short and long combinations, as opposed to this position. Well, okay, let's take a look at it. That wasn't shown in our rollouts, so that means I'm going to the custom spread tool, and I'm going to go ahead and buy shares of S, at $7.97. We know we're at a $1.30 loss. Now, we want to sell first. Take a look at what this looks like. We're going to sell the 2020 7-strike put, $1.47. We're going to get a little bit better. We're going to put in $1.65. Okay, midpoint there. So we're going to buy one. We're going to sell one at $1.65. What do I have now? I've got a stock and a naked put. My margin requirement at this point essentially doubles, okay, because I have to cover the margin requirement. And it's still a bullish position, okay? my break-even drops down to exactly where we are, $6.67, somewhere in that time frame. Okay? But now to hedge any further losses, we're going to take some of this $1.60 premium. Oh, I'm sorry. Yeah, there was $1.65 at the 7 strike. That's what I have right now. You might have had a different price. I'm seeing $1.65 for the 2020 7 strike put that we're selling. It does lower my break even about to where we are now. 805 days away. But we're going to hedge that a little bit. We're going to look at our January 2018 in the money 8 strike put for $1.47. Okay, whoops. All right. Now your break even's $8.75, and that's at January expiration. Near term, not far term. You get 20 cents of net credit to lower your cost basis, but you still have a margin requirement between your short put and your long put of an extra $1, so the risk actually increases to the downside if it continues to fall. Okay? All right. So that's what we kind of look at with these scenarios here. All right? And that's, I don't know if this is a great trade. There are other combinations that we might want to see, and one of the most popular things I would do is, let's talk about this. You're down $1.30, 16% on the position. I don't know how many shares you have. I don't like this as an adjustment. This doesn't satisfy any of my needs that I'd look for when adjusting a position. Yes, you collected $1.65 for selling that put out to 2020. But this isn't going to decay at all. You're not going to see any time decay on this position until you get closer to expiration. This is not a realized premium. If I had to buy it back 4 months from now and the stock's still at the same price, I'm still probably paying $1.25, $1.30. I only made 30 cents off of it. And where's my 8 put at that point? It's going to maybe $1 of intrinsic value. Okay, it's right at intrinsic value, in fact. A little bit extra. So I'm not gaining time value, and I'm not losing too much time value, but I'm not gaining it. Unless the stock drastically recovers, this doesn't give me a good feeling. I don't like this as a repair. How would I repair a position? Well, the first thing I do is take a look at the stock repair tool that we have here, and I'd see if there are any opportunities. 100, nope, 797, and 100 shares. Hey, there's one for November 2017. Oh, it's a debit repair. There are no credit repairs available. This tried to build a ratio spread, but with these combinations, you see that it's going to, and it's finding a different break even based on buying a strike and selling a higher strike at a small debit on the position. So here you could still lower your break even using the stock repair. But if you wanted to see a credit repair, which I prefer, again, I don't know how many shares you have right now, what your holding is, but if you did 200 shares where 100's at $7.97 and the other 100's at the current price of $6.67, well, what you're going to end up with is a new cost basis of about $7.30 odd cents, somewhere, let's call it $7.35. All right, 200 shares at $7.35. Still no credit repairs, but look, there's debit repairs in the near term where you'd only need the stock to come back to $7, $6.98 or $6.99 to help you get back to break even. I think this might be a better opportunity for you, a better way of viewing things using the stock repair or a different type of technique. I'm not a fan of the repair that you suggested, Mark S. It just doesn't look like a good combination. Now, Rajiv, I'm going through the other questions that came in. There's a lot of questions still to address, folks. I know we're already at 5:07. Yeah, and Rajiv says that Sprint might be a news-driven. There's a chance it will recover based on the T-Mobile acquisition news and so forth. So that's something to consider, is what news is coming forward, when are earnings, and how would that affect the repair you're doing? And did the adjustment that we were originally evaluating, I apologize, folks, let me go back. It's gonna, yeah. Does this help protect your downside and help you increase your break even? No. I don't think this is a good position to be in. I don't like it because the protection, you didn't protect the stock by buying this put. All this put is doing is canceling $1 of the obligation, or most of the monetary obligation of this extra put. If the stock continues to fall, you're still losing. You're losing on the stock because this one put you bought can either only cover the naked put that's far out in time or the stock. It can't cover both. Rajiv says you could be better to buy a call. Well, that's what the ratio spread does. You're going to buy one and sell two to get a lower price for that long, and if it recovers as you expect, yes, you cap your gain potentially with that ratio call stock repair, but you can get back to break even faster. Now, if I'm expecting a big turnaround with this acquisition news of Sprint going to $9 or $10 per share, sure, averaging down and buying calls might get me to a great profit if it goes back to $9.50. I don't expect that personally to happen based on the news, but you never know, okay? You just never know. Now, all that being said, the important part here and why I'm not spending that much time going through this repairs for this stock and what else could be done, I showed you the graph of what would happen if you did that position. If that still matches your personal goals, Mark, for what you would do to manage Sprint, go ahead. It doesn't satisfy the two needs I have to try to repair a position. It did not lower the break even. It did not give me any extra protection to the downside. And I'm not a fan of selling options, calls, or puts that are that far out in time because I can't assume that that $1.65 premium I received is going to be realized anytime soon. We're talking 3 years away almost, a little bit over 3 years away. So that's what I'm doing too. Sam, I don't want to say points out the obvious, but Sam points out something that we commonly refer to and we showed it in the Strangle. Sam says, sell Sprint, find a better stock. It's kind of like what I said with that short Strangle. Close the position, take the 37-cent loss, and move on, rather than doing the management techniques on some occasions. All right, but here I am at the webinars page. Oh, there we go. Chat window is what I need. Sorry, folks. There we go. www.powerop.com/webinars.asp. It's our public page. This is where you can see the different archive presentations I talked about. And one of the ones that's here under the options concepts is manage your broken position. Here we discuss alternative methods for managing a stock position that has fallen against you, a covered call that's maybe moved against you, managing a naked put that moved against you and you've been put the stock, and more. Okay, so we talk about more in depth here at this archive webinar, which is free to watch. Just go to powerop.com/webinars.asp, click on Options Concepts, Manage Your Broken Position. And then you'll be able to go that walkthrough of the 4 or 5 different ways we might look to manage a stock that's moved against you. Pros and cons of just selling a call, which remember, if we just sold the out-of-the-money call 28 to 35 days out that we saw, we'd get about 17 cents. That would only take me 10 months to get back to break even, assuming no real movement based on news, not getting caught and being assigned for a loss, and a lot of other things. That's true, but it just gives you a base mark of how long it would take you to repair the current $1.30 loss using the just out of the money short call premiums 30 days out in time. Okay? All right. Now, got several other questions in here, and some of them are pretty long questions. But first things first, in order. David, been patient. David H. There's another David question later on. David H. wants to discuss the settings for Weekly Iron Condors. Okay, so let's go ahead and add Iron Condors to my menu and save that configuration here. Go into search. All right, let's see what we've got here. So one of our default settings is Weekly Iron Condors. And there's Activision today just after earnings drop of 225. 6160, 6667. That might be an interesting one. It's kind of funny it pulls that one up. Okay, so what are we looking at for our Weekly Iron Condors? Well, the default Power Options tools, we're looking for a days to expiration between 1 and 10, total net credit of 25 cents, maximum risk less than 10 to be 10 points. If you only wanted to look at 2 or 3 or 4 point spreads, you would just adjust the maximum risk. So if I only wanted to see, 2 point spreads or less, I change the maximum risk to be less than $2. So I'm going to get some credit regardless. So if I don't want to see smaller positions, we'll just do that. Minimum 4% return. Now, the percent out of the money range. First off, we want the short call and the short put both to be at least 3% out of the money or more. And we're limiting just the bid-ask spread, so it's easier to get filled at the midpoint, and you might want to consider using the percentage bid-ask spread to keep that under maybe 20 or 25% to get a tighter grip, so you know that you're getting filled at a reasonable midpoint. But again, when in the weekly series, minimum 25-cent net credit. I put the maximum risk down to 2. You can put that wherever you want. That's helping you set the difference in strike prices. I do want the same strikes on both sides. Now this percent out of the money range, this is a filter that's allowing you to set where the stock price is in relation to your short call and your short put of the Iron Condor. A range of 50, a percent out of the money range of 50 on an Iron Condor means the short call and the short put are equidistant from the current stock price. So that's why my range is set to 40 to 60. I want it to be as close to between the two strikes as I want. If you've been tracking a stock and it's been moving up, but now you feel it's pulling back and you want to set up sort of a bearish sentiment, you'd skew this to one side. So you'd be looking for a percent out of the money range between 70 to 90. So you're right near the short call strike price, but that short put is way further out of the money because you think it's going to pull back. Reverse, a stock that's fallen, you think it's going to move back up, you'd skew the percent out of the money range the opposite way. You'd look for something maybe 0 to 20, so your sort of short put is at the money, just slightly out of the money, but the call might be very far out of the money as well. Okay, so this helps you dial in where you want the stock price to be. I prefer it to be right in the middle when I open a position. What else is there? Really not a lot. We're making sure there's no earnings between now and expiration, but we don't really have any technicals or fundamentals in there. It's really hard to gauge what you might want to put in for the technicals in this scenario. I might use a percent Bollinger Band percent Bollinger Band width to be relatively small, but I want that to also be continuous. I don't want a condensing stock that looks like it's about to break out. I might want something along the lines of IBM, which has had a condensed Bollinger Band for 3, 4, 5 months. This doesn't really allow you to do that, but you could set it in that fashion. You could look for positions where the MACD has been over the signal line for maybe at least 5 to 10 days. It's just shown a constant growth, but it's just been still holding that and not been switching. Okay, a longer term trend over or under to look for sort of a neutral position as well. So that's essentially what we're looking at. And that's what we're using as our default criteria here as well. Okay. All right. Now, this is an interesting question. David says the bull put is a 2-week to expiration. Why is the Iron Condor only 1 week, not 2 weeks? The key is you can set it any way you want to, but I know why you're asking that. When we did our credit spread search, I said that the best results for a bull put credit spread, and I've just done the testing again, and I confirmed that the same criteria we're using were the best results we found over that time with about 20 different iterations of criteria. That on the bull put, going 2 weeks out was much more profitable than going 1 week out. Why? Because when we go 2 weeks out, we might be getting 20 to 25 cents of net credit. We go 1 week out, you might be getting 12 or 13, maybe 14. You say, oh, but if I get 14 every week, I'm getting a higher return than 22 cents every 2 weeks. Yes, but one loss, even if you're using a 1-point spread, one loss when you're only generating 8 to 14 cents is going to wipe out 10 trades. If I'm generating 20 cents up front, it's only going to wipe out 5 trades. You go 3 weeks out, you still get a better premium, but the return was slightly lower. And I took the same criteria that were successful, stock technicals, fundamentals, similar range out of the money percentage-wise by days to move, net credit and percentage return, and used a 1 week out series. We lowered the net credit based on just going 1 week out compared to 2 weeks. the bull put criteria we set, when you set it to 8 to 14 days, it's about an 85% return. You can call it 850, but we call it 85% return over a 29-month period. Using that same criteria, lowering the net credit because you wouldn't find any results with a higher net credit, but lowering it to only 1 week, and same criteria, was a 29-month loss of 72%. Go figure, right? The losses, the win-loss ratio is about even, but the losses compounded more quickly because you're only taking 8 or 10 cents up at the beginning, so a one loss is wiping out 10 to 12 previous trades, and it compounds more quickly. Why didn't we do that with the Iron Condor? It's because the total net credits doubling up are in that higher range. So you could do a 1 week out Iron Condor and be more successful, because if I do take a loss on a 1 point or 2 point spread, I'm only wiping out 5, 7, 6 trades. It doesn't compound as quickly because of the higher net credit. Okay, that's the reason why. Is it similar probabilities looking at a 1 week out bull put spread? I'm sorry, if you're looking for a 75, 78% probability, here probability between of 75 or higher, but you can see I'm still getting a higher percentage. I'm still getting a higher percentage net credit. Even here at 27 cents is the lowest on this screen, and 26 cents, my apologies, is the lowest. But these are all 1 and 2 point spreads. So if I took one loss at a 2 point spread, I've only wiped out 10. Whereas if this was just the bear call side, short call of 12, short call here, premium, with the midpoint, it probably would have only been, let's call it 13 cents. So one loss would have wiped out 10 previous trades. Okay, and that's the reason why. You're getting a double credit that's actually benefiting you where you can go shorter term. I'm never going to advocate, I had a discussion with a gentleman on the phone today looking for positions that expire, was it bull calls or bull puts? It was bear calls. Bear call credit spreads, I believe, on Priceline that expire today. I would never encourage a 1 or 2 day trade, but well, you can get the premium you want and in a range that is reasonable for an upper and lower break-even range on a stock you're tracking, and you can get 40 to 50 cents on a 7-day trade. That's phenomenal. Most of the bear calls that have the probability you want and the stock trend that you want without too much volatility and fluctuation in recent times, you're going to be seeing 8, 7, 10 cents of net credit on a 2 point spread, a 1 point spread. Remember, 10 cents on a 2 point spread, if one loss goes against you, you've just wiped out 20 previous trades. 51 cents on a 2.5 point spread, that's good wide spread there. We're looking at, is that Amgen? Oh, it's Baidu. I'm sorry, it's Baidu. In this situation here, of course, if I did take the full 250 loss, sure, I've wiped out 5 previous wins. Not 10, not 20. Okay, that's what we saw in the bull put credits, is that when a loss was taken, it wiped out almost 5 months of previous gains because of the smaller net credit. And we're not trading 10 or 15 contracts at a time. We're only trading, 10 or 15 positions at a time. Our testing was based on taking the top 3 or 4 positions and investing your criteria into that as well. Okay, so that's what we're looking at here. That's why the Iron Condors are looking at shorter term, where the bull put and bear call credit, standard debit and credit spreads, our weekly search, we found it best to go 8 to 17 days out in time, that 10 to 14 day range for weekly bull puts to get a more reasonable premium. Yep, there you go. So let me find my net credit here. Did I change this again? Oh, I must have changed this during the last one. There we go. So here we are, 22 cents, 23 cents on a 5 point spread. That's a little bit much for me. 21 cents on a 2.5 point spread, and so forth. We're the 1 week out positions for this series. The 7-day out for November 10th expiration would only be 13 cents, 12 cents. Now it looks good because it's going to have a higher annualized return. But as a track record, as a performance long term. The losses compound too quickly, and you're taking out more of the wins as well. Okay, so Rajiv, I don't know if this is a question or a comment. Rajiv says, after earnings, seeing a huge spike in a stock price when the market opens normally, stock price went down to a reasonable level. How to take advantage of this scenario? Apple opened after earnings announcement at around 176, but when the market opened, normally moved between 171 and the 174. How to trade this? Don't. You're taking one example of Apple and saying, hey, Apple did this, and it had a run up to 176, and then at earnings it traded the rest of the day between 174 and 171. How to take advantage of it? I don't know, because for that one example you gave me, I can show you an example of a trade Ernie made last week where the stock gapped up after hours 8% and moved up another 5% straight direction the rest of the day for a 13% gain in a one-day trade. It didn't pull back and then bounce between that. Not every stock is going to do what you just mentioned. That's the tricky part with earnings. I mentioned ATVI, a position that I'm in. Last night, I track them, their position. I didn't have this as a strangle, thankfully. But see, the stock's down 225. Okay, and let's go back to my chart here, and I don't think I saved it. But you know what I saw last night that was very, very confusing? In the after hours, by 4:15, the stock was down 180. By 4:50 or 4:45, the stock was at 65.99, up 80 cents. Okay, so it originally dipped, then it recovered. It was one point after I was trading was at 65.99. And then today, of course, it opens, but it didn't just open at 63.22. Okay, what it did, let's just change this. Let's go to 1 day, 15 minute. All right, so it spiked down, and then it did kind of what you said yours did, is similar range, but it dipped down, and then it crossed, but it didn't really show a full Bollinger trend. Maybe I should use a shorter time frame, but in any case, I'm not looking at the MACD here. But then it crosses back over, and it moves back up, and then it moves back down. How would I trade this? Well, number one, I don't do day trading with options. I don't try to mess around with it, because during this whole time, what else is interesting is that implied volatility was spiked at around this time during the day. By here, when the stock started to move back up, the implied volatility crush was in full effect. Okay, so there was still high IV here because it moved down. It crashed from what it was the day before, but it was still relatively high. Then it starts to fall. So by this point, what you're buying and selling has no volatility in it whatsoever. It's just back to normal, especially the 1 day out, 3 day out, 5 day out trades. And then, of course, as it moves back here, we're just back into a normal cycle. Now, this, of course, did what Apple did. So how could you trade it? Well, you could sit there and drive yourself nuts. Okay, so what could I have done here? I see the stock gap down. I didn't trade it. I don't have any other trades on it. I see it gap down this morning for earnings. And I say, okay, I think that trend's going to continue. So right here, I buy a 64 put. I follow it down at 62.20. I sell that put for some profit, let's say 80, 90 cents, 90 cents, whatever. And then maybe, I see this little crossover here. So now I buy the 64 call at this point for probably 30 cents. And as it moves back up here, I maybe sell it for 60 cents. I don't trade this way. I'm never going to bother trading this way. And you could say $1 or $2 move in Apple would be better as it moved from 174 down to 171. Well, if you bought the 174 for $2 and it moved to 171, you could have closed it for $3.50. Good return. Great return. But then you got to know, is your timing right to sell it at 171 and then jump back in at 171.50 and buy a call, so when it goes back up to 173, you close it then. If you trust your timing enough to do it that way, you can do that. But playing an option that's 10 or 14 days out in time, this is all noise. This is mostly just noise. And you're not going to be able to get much of a profit on it as well. Okay, you're not going to be able to get that strong profit on that position. Okay, yeah, Facebook did that also. And if you're tracking those two stocks, go back in history. Okay, and I'm not trying to be negative. You're telling me, Rajiv, what happened today in this one instant. And I'm telling you my thoughts on why I don't day trade options, why I don't really day trade stocks. Well, I really don't have the time, personally. You know, this is what I do during the day is I'm working on articles and upcoming webinars and phone calls and emails and things of sort. So I trade for a side job. I trade because our customers want me to trade. They want to know that they're getting good value for someone who's gone through these experiences. But I don't have the time to dip around and keep going, following every little dip and every little spike, trying to day trade after an earnings announcement going forward. And what I mean is, even if with those 3-point movements, when you looked at Apple, when you looked at Facebook, they did kind of the same thing. These two instances of what happened to earnings in this particular cycle, if you were trying to trade options that were out to December, your returns would have been muted because it's in the noise. And it's still 30 days out in time. All right, you're not getting any time value decay in your favor when you're selling. You're not getting really a lot of increase in intrinsic value, though you might be if you timed it exactly right. I don't have the time to sit and watch a chart minute by minute and try to time my buys for my calls after a dip after earnings and then an hour and 40 minutes later catch the upside and then sell it and buy a put to catch the next 2-hour and 15-minute cycle where it's hit its new low and then I can get out of it again. We have 3 examples here that do exactly what you said. I agree with you. But here's what you need to do. Facebook, Apple, the 2 that you saw today, go back in time. Go back 2 years in time on big charts, on any chart, and see if you can find a one-day chart. You might have a better luck on Google Finance than big charts. See if you can find a one-day chart and see if you can see how the stock reacted after each earnings. My thought is that each time is going to be subtly different. It's going to show you a different pattern, a different reaction, a different movement than what you saw today. One might be the same. One might be the same but the opposite. Instead of gapping down in ATVI, instead of gapping down, then coming down, then crossing over, going up, and then coming back down again, maybe it gapped up, then came down, then went up, and then came down, or vice versa. Okay? I don't think you're going to see a lot of consistency. So when you ask me, how can you play a stock after earnings to ride the sudden gap? There are people out there who kind of teach ways. There are people who teach strategies to get out right before the earnings, getting in 5 or 6 weeks beforehand in a position to play just volatility and not even play the gap at all. There are people I know who do spreads. They'll play a gap down here as a bull put credit spread. As soon as they see a gap down stock, they'll trade a bull put thinking it's going to recover. I know a lot of people who do the opposite. When they see a gap down, they'll play a bear call. And I've seen stocks that have gapped down here and just continued down during the day. Stocks that I've been in. There was no recovery. There was no movement up. It was just, it gapped down and it just went down. And I've seen them gap down and come right back up to where they were trading the night before. Okay, so there's many different scenarios. I don't think you're going to find one distinctive pattern for every stock around earnings. You need to go back in time and check. Okay? Okay. All right. Long theoretical question. I was just reading through it. I'm sorry, it's not theoretical, but it's a long discussion. It's probably a long discussion. It might be something I'll have to do for next Tuesday in a radioactive trading webinar. But let's get to what we can get to, shall we? David M. Yeah, David H's questions. Now we're at David M's question finally. He's been patient with us. David M says, I've been trading the RPM for several months. My problem is my expectation, what we call the SIGA model for the stock, maybe considerable upside, so I trade from what I think is growth. Next trade, my expectation may be different, so I trade more for income. Okay, should I pick a style of trading and stick with it, or can you switch back and forth between trading styles? Oh, okay, so when we talk about the radioactive trading technique, let me go here. Those of you who are unfamiliar with it, it's a limited risk technique where we control risk upfront to single digits. The full description is talked about in the blueprint. I'm going to buy stock. I'm going to buy a put option far out in time that matches the guidelines of the blueprint. So any position I open cannot risk more than 4 to 8% or so, or single-digit percents when I open a position. We're then going to look to do different adjustments, income methods on the position where we're going to sell premium or do other adjustments to eventually lower the initial at risk to a point where it's bulletproof. No risk on the position to the downside, still unlimited upside, and we can still make trades off of the stock and put combination. Now the blueprint does discuss two methods of doing it. One is growth. Longer term growth, lower volatility, dividend paying stock. Okay? Something that I know that even though I can sell calls against it, and even though if it offers weekly options, something like Johnson & Johnson, Hertz Global, Citi Financial, CFG, Citizens Financial Group, another one that I'm in, which is a growth one. I'm not going to be looking to do adjustments every 10, every 15, every 30 days even. It's slower moving volatility with a dividend for extra insurance and a low risk. Okay? That's what I consider growth. That my projection over the next 8 to 10 months, maybe 12 months, is going to be a 10 or 15% growth in that sector, industry, or that underlying security, and any income methods I can do over that time. It might only be 5 over a 10-month period or 6 over a 1-year period. I'm using that to enhance the projection of longer-term steady growth, getting some dividends in, just as you would with, a dividend stock, for example. But what are the income strategies? Well, that's something that has more risk. Starbucks. I'd say Guideware Software. Don't even know what that is, but I bet you it moves more frequently than Johnson & Johnson or other growth ones. Is there a mix in here? Yes. Is it okay to have a mix? Absolutely. And that's where I stay as well. Okay, let me pause here. I can't go back to that. Let me move over here real quick. What I want to do is I'm just going to actually show you something very quickly. I made a mistake today. I'm not actually logged into the webinar account. I'm logged into my own account. Okay, so my current positions. Applied Materials was opened as a Mary put within the last 10 days. Mondelez, I've been in for 232 days. It's not really a positive position for me right now. I'm still managing it, and it's going to expire in 14 days, but I'm still going to manage that position and collect some dividends. This was a growth position. This Mondelez was opened as a growth when the market was a little bit more volatile back in March. I've done a couple adjustments off of it. I've lowered the initial at risk. I had a low a low profit on the position at one point. But yes, this was designed to be growth because even though Mondelez offers weekly options, my plan was that this stock had the potential when I opened it in March that I thought by now, 7, 8 months later, I'd see a 10 or 15% growth in the stock. And it started out that way, right? It was a growth stock. We got in somewhere around here after that big move. And yes, it dropped back down, but then it moved back up. And at one point, it was at 47. We had moved the put up. We had bulletproofed the position, I believe, at this point, and then we did this. Now, I should have just closed it here, but I kept managing it, thinking it was going to come back, and then it duped me again. Okay, so this wasn't the growth pick I really should have taken. But I wanted a mix. At the time, I was in AEIS, which to me was a growth stock. It went up, the stock itself, 23% in the first 5 months I was in the trade. Okay, that's more growth. Planet Fitness, smaller movement, but I was impressed with its earnings on the last cycle. It's got earnings coming up in 4 days. I thought this was a movement. It's growth, and it's up 9% since we got in 66 days ago. That's a good growth, but it's not income. Why? Let me show you very quickly. It's a $26 stock. We got in at 24 something, 24.10. It's at 26.82, right where I want it to be, in a sense, to make another adjustment. It only offers monthlies, and it only offers 5-point strike differences. If this stock offered weeklies and had single strike differences, I would have been selling out of the money calls and income method number 6 positions. I would have done at least 4 in the last 66 days, I believe. Probably 4 income method number 6s in the last 66 days if it offered weeklies. But when I saw that it only offered monthlies and only offered the strike difference of 5 points, I use this for growth. I'm not going to adjust this position. I have a certain target already set from when I'm going to adjust the put. I could bulletproof it today by rolling up to the 30 strike put. I just haven't yet. I will likely before earnings come out in the next 4 days. So I'll go into the position with no risk and still unlimited upside. But to answer your question, David, on this first part of your question, if they do offer, for whatever reason, if Planet Fitness starts offering single strike weekly options next month, then I will start trading this as income, but still projecting growth. I have a target in mind for this. I set it up as my trading plan with the blueprint. I have a target for when I'm going to make my first adjustment. I'm essentially there. Knock on wood. I should have done it today because who knows what Monday is going to bring. It's probably going to pull back on Monday. But I know that I could roll up right now and bulletproof this position before earnings, which I probably should have done today. I just didn't because I was looking for a specific target. Okay? But in any case, it's okay to have a mix. And it's okay to change your mind. The SIGA model you mentioned, the process we use for opening a position. When I open any radioactive trades, because I believe it has the potential to move up 3 to 6 or 3 to 7% in the next 20 to 40 days. Now, if I'm in that stock and my sentiment changes, then I'm going to change my SIGA model. If I'm in that stock and I realize that this looks to be better income than growth, that the growth is just not showing and the prospects don't seem to be as strong as I originally thought it was, then yeah, I'll start looking at more of an income than a long-term growth position. But I have a mix in my portfolio. AMAP to me is income, ATVI is income, but it's getting close to expiration. CFG and Mondelez in the Fusion portfolio, they were growth. One is, one isn't. Sorry to say that. And Planet Fitness right now is, to me, a mix of both. It's growth, but I needed the growth before I could look at the income. And I'm going to start looking at the income really soon, okay? And you say, should I stick one style of trading? No, I think you want to mix. At any given time, about 20% of my open radioactive trades or so are stocks that pay a dividend and have a lower volatility. And the others, actually right now you can see it's more closer to 40%. 2 out of the 5 positions I have open right now are dividend paying stocks. Decent dividend, not great, but dividend paying stocks, okay? And your second question is, when do you close a profitable trade? What percent of the stocks do you hope to capture? Well, 60%, 55 to 60% is what I usually expect. When I have a stock that's up in price, even with the married put not in place, I'm going for 55, 60%. Example, Planet Fitness is up 9%. Okay, this isn't quite there. I'm up 4.3%. A week and a half ago, it was up 8.9, and I was up 4.9. Okay, so I was well above the 50%, 60% range that I had made on the position. But my plan is not to close it. Okay, so that should be your target, I believe, is you should still expect to make 50 to 60% of the stock movement. What's more important is your goals. All right, I could liquidate Planet Fitness right now for 4.3% gain in 66 days. That's not bad. 30 days out, let's say 30 days, 2.15%. It's sort of like a safe covered call return. Not great, but again, this is the protected part of my portfolio, not the leveraged part, not the spreads part, not the diagonal part. This is just, 50 to 60% of my trading capital is devoted to these secure positions, okay? And so that's what I'm looking to accomplish. But I also have a goal in mind, and that's where the trading plan comes in. Okay, so when you exit a position, number one, you want the return to match your trading goal of what's going to be successful, what you set up to be successful using that trade simulator tool on radioactive trading. This applies to all strategies, by the way. We're not just talking about married puts. Whenever you just are questioning to close a position, you should close it when your target's been hit. As far as this strategy, even if you don't do an income method, as the stock moves up, you should still expect to make 50 to 60% of the gain in the underlying security, even with the put in place. And of course, if the stock falls 20%, you're only going to lose 5. All right, so you're hedging that very well. Okay, that's kind of the trade-off there. Is when I look at those strategies and look at those ideas. General guidelines for rules of growth versus income. There's none. Okay, the guidelines for both apply the same. What I mean by that is, David, the guidelines of when you do an income method, number one, apply exactly the same to growth or income. I'd say the one difference is that on ATVI, I could sell an income method number one maybe 14 days out and see a 2 to 3% return against the investment. Whereas on CFG, if my requirements are met for income method number one, I'm probably selling a 43-day out option, which I did today for the December 40 call. Okay, I couldn't sell November 14 days away because it was only worth 20 cents. Doesn't do me any good. I had to go to December to get a reasonable premium of 75 cents. Whereas today on ATVI, I sold the 14-day out November 65 call today, did two income method number ones, and got 90 cents because of more volatility. ATVI is income, Citizens Financial is growth. So what's the difference? When you do an income method of selling the call, income method number one or income method number 6 to generate premium or 5 on a position, on a income position, you're going to see good premiums and good returns, shorter time frame, 14, 20 days out. On your growth stocks, you're probably going 35, 45, maybe even 50 days out in time to get the similar type of premium. That's the main difference, is it's more time to get reasonable premium between the two. But I also have the potential to have to adjust this more quickly than I will CFG. CFG is going to be more gradual, and if it does continue to move up, that's great for my position. It's not going to suddenly go up above 41, then drop down to 39, then go back up to 43, then drop down to 36. ATVI might. ATVI might gap back up in the next 4 days and be trading up again at $65, $99, $66, $67. And then 2 weeks later, it could be at 61. So better premium shorter term also means potential for more frequency of management. But I like a combination of both in my portfolio. To have the good, reasonable growth stocks, and this one was pretty, CFG has been pretty reasonable. As I mentioned, Mondelez was not, duped me twice. Planet Fitness, really good growth and has the potential to be an income, whereas Applied Materials and Activision, yes, I was bullish on them, but they are income plays, and I just haven't touched an income method on Applied Materials yet because I want it to show its hand. I've only been in for 10 days. I didn't want to sell a call. I should have sold the 57.5 call right away when I got into the stock for 40 cents because it would have expired worthless today. But again, I didn't know that. My projection was it would be higher. Rajiv, I'm just going to give you a quick, I'll mention this later on, Rajiv. I'll send you an email Monday or later this weekend on IM number 5. Income method number 5 is a ratio call spread done in the context of the married put, similar to the stock repair. And Rajiv says, well, how do you manage the short call in income method number 5? The short answer, just like income method number 1. If I'm in an income method number 5, I've sold 2 higher strike calls and bought a lower strike call, and the stock continues to move up and it goes above my short call strike prices, I'm treating one of my 2 short calls as income method number 1, just selling the call. I'm leaving the long call and the other short call in place because the stock continues up. That just means I'm getting maximum profit on that bull call debit spread. The short call is the other short call that's covering the stock is the one that's hindering me, so I'm going to manage that just like I'd manage income method number 1. Okay? All right. Yeah, Sam, going back to the other point about the earnings there, Sam had mentioned that, you know, he says Facebook always moves lower after the earnings, but after the earnings you need to wait for the stock to settle and the volatility as well. I agree, because whether you're trying to, and Sam pointed it out earlier in the discussion, when we were talking about that ATVI stock position, what we were looking at on that day chart, which I believe I just lost, but we were talking about it on the day chart for ATVI, when I showed that volatility and we talked about how after the first gap, the volatility was still high on that position. It hadn't had the volatility crush yet. But then when it started to move back up, that's when it happened. If I bought a call in the first 20 to 30 minutes of trading, thinking it had bottomed out, it's going to move back up, I was still paying into a high implied volatility. 2 hours later, that implied volatility is gone. So I lost, unless it moved up more intrinsically from 61.18, you know, and moved back, not 61.18, wherever it dropped lowest today, 63, and moved back up closer to 64, I was seeing implied volatility crush on that long call. At the same time, I was gaining some value. I might have sold it at the peak at 64, picked it right, and I may still have lost money depending on how much implied volatility I paid for. So I agree with Sam. Wait for it to settle, wait to see your implied volatility, and then go there as well. Okay. Oh, Sam was okay. Let me do this real quick here. Let's just go back to where we were. Sorry, charts, big charts, and 1 month. No, 1 day. I go 5 minute. All right, so now here it is again. It dropped down, bottomed out here at one point at 63. If I had bought a call here, it's probably still expensive. Yada yada yada. Sam says to take a look at Tesla. So yeah, the earnings gap down, and then it just kind of went up, 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 up. I think that's what you're saying. Yeah, it says was up $6, and it could do a debit for 300 to 310 next week. Okay, that's something he's considering there as well. Okay. Okay, Rajiv, I can't answer your question. Rajiv says, in our last call, we were looking at AMD married put. He says he's now seeing a reversal in the stock, so he sold to close the put. He's now only holding the stock. Says, should I use that money to buy more stock or buy more calls? Now, I can't really answer that because you know I don't do that. I never leave an open stock position uncovered without a put. I know you're using trailing stops and so forth, but I never do. And you're watching the market close to me. I never do that. What's the advantage of the two? Okay, well, if you use the money that you took from the put to buy more shares, you're increasing your position and you don't have an expiration. Simple as that. If you use that money to purchase the calls, you've got great leverage in your favor. So if there's still a continued move up and you catch it at the top and can sell to close the calls before it drops again, then you've made money. However, if it drops and you hit expiration or close to expiration, you've lost that money you've put into the calls. So there's your real comparison. Buying the shares of stock is not leverage, but it doesn't have an expiration. And if the stock falls, you could still hold those extra shares if you feel it's going to come back up in the next month or two. You buy the call 30 days out in time, you can buy maybe 2 or 3 contracts. Great leverage. If it moves up 5 or 10% from here, you're going to have a fantastic leverage return on those calls. However, if it stagnates or drops a little bit, doesn't recover before expiration, you could lose everything you put into the calls. How bullish are you? How positive are you in the return? How positive are you in the move going forward? Okay, that's what would answer your question. Okay, that's really going to be the ones there also. It's very hard to answer that because the other thing is, another idea that you might consider is that how bullish are you on AMD and how long do you think that trend is going to continue? You mentioned you might consider buying the April calls on AMD. Sorry, let me take a look here. Oh, shoot, I'm on the wrong view. That's why nothing was moving. Okay, so I can't give direct advice, as always. Everybody knows that. Let's see here. Oh, let's go for 6 months. 3 months. There we go. Sorry, I'll go back to AMD. So it's had this dip, but now you're seeing a reversal. So the calls give you great leverage. I can show you stocks that I've had that have had that breakout in earnings, had the lower Bollinger Band crossover and the positive signal with the MACD, and went a little bit and then went straight down. Okay, my signal here is if the MACD is crossing again and this starts to move in this direction, this pans out and the stock continues to move up. I see too many times when you see this Bollinger Band signal where it closes below the lower band the first day and the second day, where it starts to come back up and then just straight down. The reverse, you see a Bollinger Band breakout confirmation, it closes up, it closes 1 day above, and then the next day it closes above. You kind of see it drip down, and then it just goes right back up. Okay, so I can't tell you how to trade. This is your signal for a reversal. You're bullish now. How bullish are you and how short of a time frame? Remember, buying the April options, buying the further out call options, just like buying the put options, which help us with the protection, but for profit, there's usually a lag. You know what I mean? That's because you paid so much for that call that stock's going to move up, but as it moves up, you're going to gain intrinsic, but your option's going from an at to slightly out of the money to an in-the-money call, so any of the time value you paid into is just disappearing because your delta is getting closer and closer to 1. And if you're this far out in time, if it goes back up to 14, you're going to have a good move. But if it just goes back to 12, you know, depending on the getting in at 11, 12 right now, you'd have an 88-cent gain on the stock. You might have a 99-cent gain on the leverage position with the call. Monetarily, what works best in your favor to get you back to break even if you are, in fact, at a loss on AMD with the married put play in right now. So, time frame, movement, leverage is good, but going far out in time, you're paying a little bit extra. If your goal long term is that, you know, maybe April, May, June, July, you think the stock might be back in this 15 range, I might be tempted to buy stock and put more cash in to now have 200 shares at an average price and then have a married put with twice as many shares at an average lower price and the same protection or better protection in place because you lowered that down. Okay? And that's the key. As Sam mentions, one cannot predict the market, needs to follow the market and go with the flow. Some news can really rattle things around. And I feel that's where the time frame we're in is that news now is going to be the most important factor moving it. We're seeing some earnings that aren't really as positive as people had hoped, and that's caused this hesitation. But it seems now that the last quarter earnings surprises were much more prominent. This quarter, they're not. Even to the negative side, it doesn't seem like there are negative ones. There have been disastrous negative ones, but they're not overly prominent. The prominent movement is something here. This movement on ATVI, I don't think I could have built a combination on a straddle or strangle that would have been profitable, believe it or not. I looked. But because the volatility was so high and the projection, positive or negative, was the stock would move more, even today's series didn't look like a reasonable profit, even with the stock down 225 today. The cost was too much. For where it was at 65 yesterday, the cost of the 65 call and 65 put for today's expiration was too high, where this would have just broken a small profit of 10%. And I mean 10% on the leverage, making, you know, 2 cents or 3 cents off a $3 debit kind of thing. Or well, that's 1 cent, you know, 30 cents. So it was tough to do. Yeah, it's, Starbucks is another example, Sam, Rajiv, that Sam had mentioned, that has that same kind of different pattern where you're not quite, it's not the same. But if you're planning on going forward, Rajiv, and analyzing, and Sam does this, you guys can tell that Sam always has 5 or 6 stocks he mentions that he trades. He's got Tesla, Apple, Netflix, I think in the video a little while ago, Facebook. He's got different plays going on those particular stocks. Usually we talk about them, and he sent me some emails today. I didn't get a chance to go through the last one on how you close the calls because I was working on the slides for the questions that came in via email. But if you're going to track one particular stock and you want to know how to trade it, don't just go by what happened one day. Or 1 day's earnings, or even 2 cycles of earnings. You got to go back 2 years. Look at 8 different earnings cycles and see how the stock reacted to positive, negative, what was going on in the market at that time. Like Sam says, and like we always say, the trend is your friend. The market trend as a whole is your friend. Follow the pattern and strategy that match the market. If you're great at chart reading and you can be contrarian and you've been successful being a contrarian in the past, that's great. That's not really everyone's game. No, I just mean it. That's not my game. I haven't had a lot of luck being contrarian and trying to pick the downturn when I thought the market was overbought, or the upturn when I thought the market was oversold, and trying to play it early. Haven't had a lot of success with it, so I stay more with the trend now, as Sam was kind of mentioning. All right, well, ladies and gentlemen, we've spent a good amount of time here. I do believe I got everyone's questions answered that came in. I just want to remind everyone that if you haven't seen it yet, if you haven't tried it yet, make sure you go to PowerOp.com, and you can just put in your first name, last name, and email address. That'll give you a 14-day free trial to test out the tools we saw today. We looked at the search, Iron Condor. We've got the same search criteria and 23 other strategies in the same structure. That portfolio tool to not only track your positions, but help you evaluate rollout opportunities and more. The custom spread tool and individual signature tools for different strategies. No credit card needed, full 14 days trial of all our patented search and analysis tools. Now, our subscription levels start at $40 per month for end-of-day data. And we do, of course, offer a delayed service, real-time service as well. We didn't get a chance to look at the historical tools, but that is a addition you can add, and our historical data goes back to April of 2006. You can interact with the search criteria using our historical data to find positions that match your criteria back in time, or look at full detailed options change historically, which is how I got the prices that we used for the ATVI example. Selling on September 29th, that 20th of October, 66 call and 62.5 put. I just used RO data to find those prices at the time. Nope. You want to check out more education this weekend? You can check out our blog at any time, blog.poweropt.com. And of course, there's other things that are mentioned there as well. I showed you and sent you the link to the webinars page, poweropt.com/webinars.asp. You can access that at any time and go through the different categories of archived webinars. The Power Options Tools category, Option Strategies, where we show different webinars for how to get into different positions, naked puts, covered calls, married puts, collars, bull puts, bear calls, calendars, and so forth, as well as long calls and long puts. Webinars on management techniques for those various strategies as well. That's all available at the webinars, poweropt.com/webinars.asp, and you can also look us up on YouTube. Now, if you think of a question later on that you didn't think of today, or a question related to the material, remember you can send me an email at any time. Just send it to support@poweropt.com. If you have questions about the radioactive trading techniques, the full work of the blueprint, and how to bulletproof your trades, send me an email to support@radioactivetrading.com or support@poweropt.com. It really doesn't matter. And you can also call us during market hours at 302-992-7971. Those of you that are trial members and subscribers, you can schedule one of those free coaching sessions at any time. So you want to take advantage of that too if you have a set of questions on the tools, on the option strategies, and more. So just remember to schedule essentially a 45 to 50-minute phone conversation with myself or Ernie. Okay. All right. And so Sam says the webinars are great. I've been coming every Friday to those. And there's also other webinars we do on sometimes Wednesdays and Tuesdays and Thursdays during the week as well. So thank you for that, Sam. Everyone have a fantastic weekend. Have a great trading week next week. Remember, some of you might have already done so and adjusted your clocks. If you're across the pond, there are parts of UK or parts of Europe if you follow that as well. But remember, for those of us here in the U.S., of course, we've got to set the clocks. Most of us. Some of us don't pay attention to that, which is perfectly fine. But remember, clocks get set back, fall back, and then we'll spring ahead later on in a couple of months. But before that, we got to go through our second trading week in November. We'll be back next Friday here with you to answer your questions about options trading and see what happens. Otherwise, have a great trading week. Take care, everyone. Good night.